Iñaki Aldasoro is a principal economist at the Bank for International Settlements, and he joined the BIS in 2016. Previously, he worked as a consultant for the European Systemic Risk Board, the European Central Bank, and the International Monetary Fund. He's the author or co-author of multiple papers on the adoption of both artificial intelligence and the policy implications of stablecoins. So today he's going to share his insights from his seminal paper on stablecoin growth and the implications for our financial system. So Dr. Aldasoro, over to you.
So first, good morning or good afternoon, everyone, depending on where you are. Thank you, Kathleen, and the rest of the organizing team at NYU Stern for giving me the chance to present this paper today. I'll be talking about stablecoins and their links with Safe Asset based on joint work with Rashad Ahmed, who is with the Anderson Institute. And before I begin, let me remind you of the usual disclaimer that it's whatever I say today represents my views and not necessarily those of the Anderson Institute, nor those of the Bank for International Settlements. So there's going to be quite a bit of continuity with the presentation that Ronit just made. So he did quite a bit of the legwork that allows me to skip discussion of what stablecoins are and how they look like in general as the general state of the market today. So we put out this paper, the working paper, the first working paper version. We just updated it, but with the very first one around April last year, I think. But of course, the issue really took off a bit later as the Genius Act moved through its legislative process and was finally approved in July. This was also became very clear in Ronit's presentation. In fact, well after we put the paper out, then high-ranking U.S. officials came out with very explicit statements about the issue we explore in the paper. Here you can see a couple of those quotes, one by Treasury Secretary Besant, done around the passage of the Genius Act, and then another one by then Fed Governor Myron in a speech delivered in November. The emphasis here is mine, and it basically is there to highlight the themes that we try to study in this paper, which we see as a sort of a first attempt to add some empirical grounding to the discussions that started some time ago, and then took got a boost through the passage of the Genius Act. Now, attention to the market, we think, is warranted, of course, as probably became very clear from Ronit's presentation, given the growth of the market and the centrality it takes as part of the U.S. New strategic direction. But most importantly, because with the largest stablecoins being pegged to the dollar and putting their largest share of reserves in treasury bills, I mean, not that much for the case of Circle, but still either treasury bills or repos by treasury bills. Stablecoins are already today an important player in treasury markets, both from a stock and a flow perspective. In the graph on the left, we plot the major holders of short-term US Treasury securities as of the end of last year, where you can see that stablecoins stand on par with the largest government money market funds and also major jurisdictions. And then on the right, we plot purchases over 2024, so flows rather than stocks. Over 2025, and here the image is even more stark. So indeed, dollar-backed stablecoins purchased almost 40 billion over the course of the past year, similar to the largest U.S. government money market funds and larger than most foreign purchases. So this is not exact one-to-one mapping to what Ronit showed you. We are focusing explicitly on the 3-month market here. That's why the role of stablecoins is even larger than what he showed. And I talked about that. We'll talk about that in a second. So what we do in the paper is try to quantify this. We're trying to quantify the effect of stablecoin flows on treasury bills. And we do this using local projections. We focus on the 3-month T-bill rates in most specifications because this is the preferred habitat of stablecoin issuers. Before Genius by reveal preference, post Genius by regulatory requirement. Or potential regulatory requirement when it gets expressed in concrete regulations. In the paper, we discuss why, if one were to do this through a simple univariate local projection of changes in 3-month T-bill yields on stablecoin flows, this would deliver bias estimates. We document the extent of this bias, and indeed, we show that naive linear projections of this type will deliver implausibly large estimates on the order of 25 basis points decline in T-bill yields for every 3.5 billion increase in stablecoin inflows, which is roughly 2 standard deviations in our sample. And for perspective, this would be in the ballpark of a Fed rate cut, which is obviously unrealistically high. So what we do is we include various controls. We control for the rest of the yield curve, both forward and recent. We include Bitcoin and Ether prices to control for overall crypto market sentiment and developments. We control for T-bill issuance. So we build a daily time series of T-bill issuance. We control for flows into money market funds, a competitor in terms of demand for T-bills, also flows into treasury bills ETFs. And we also control for monetary policy shocks, which we compute as is standard in the academic literature, looking at changes in 3-month OIS rates on a 30-minute window around FOMC meetings. When we include this set of controls, and the estimates go down by an order of magnitude to the tune of like 2 to 4 basis points. But then to better identify the effects, we also implement an instrumental variable approach to try to instrument for stablecoin flows using a daily version and like an enhancement of a crypto shock series that we propose in another paper with BIS and ECB colleagues, which delivers what we consider as our baseline effect. And this ranges from 2.5 to 3.5 basis points, which is more or less comparable to what the literature has found for small scale QE. We do a good chunk of robustness checks to the baseline results in terms of controls. I'm going to be talking about a few of those. I think the one I would like to highlight the most is the fact that the effects that we find are not there for yields in other tenors, basically outside of the 3-month tenor. I'll talk a bit more about that in a few minutes. Then our baseline effect tends to be relatively large when we stack it against evidence from the literature for other treasury market investors. So then what we did in the updated version of the paper is we took a cue from recent work by Stein and Wallen and Davernas and Van de Veer at the Journal of Finance, and we investigate state-dependent effects by looking at liquidity regimes based on the overnight repo facility at the Fed, as well as the prevalence of concerns around the debt ceiling. And the idea here is to try to split the sample into low liquidity periods and high liquidity periods along the lines of what these papers do. And indeed, we find that effects are large when liquidity is low, and they are small and statistically not significant in general when liquidity tends to be high. So let me briefly tell you about the data sources we are using for you to have an idea what the sample looks like, and then I go through some of the graphs and some of the descriptives. We have daily data that runs from January 2021 to March 2025. We consider the largest 6 US dollar peg stablecoins, which we then aggregate into a single number, and then for which we compute the 5-day change. As I mentioned, we consider Bitcoin and Ether prices. We consider the entire US Treasury yield curve, build a series of daily Treasury issuance, and then from Bloomberg, we take money market fund flows and Treasury ETF flows. And then we use tick data to construct the monetary policy shock series. And then, as I mentioned earlier, I'd like to spend a bit more on the shock series. We use this daily, we call it crypto shock for want of a better name. It is effectively the unforecastable component of the Bloomberg Galaxy Crypto Index. So what we do, which is by the way, for those who are not familiar, is an index that collects a lot of crypto prices, not stablecoin. It doesn't have any input from the stablecoin side of the crypto world. And what we do is we try to purge financial market developments from this index through a simple supervised learning algorithm. To do this, we use information on the VIX, so volatility index, the CT economic surprise index, the S&P, oil prices, gold prices, nominal effective exchange rates, 3-month yields as well, the term spread, and also the financial condition index from Goldman Sachs. And on top of that, we also use previous observations of the index itself. And whatever remains unexplained in terms of developments of the index, after accounting for all of these things, is what we consider our crypto shock series, our instrument. And the goal of this exercise is to capture basically idiosyncratic crypto variation that is unrelated to broader traditional financial market conditions, but could be used as a plausible instrument for stablecoin flows. Then we construct this series of shocks, and then we take the cumulative sum and then use it to instrument for stablecoin flows. Now, this slide gives you a measure of the growth of the segment of the stablecoin market that we study. For this audience, I would imagine the graph on the left is very well known, and Ronit actually gave you exactly this graph. So let me focus on the one on the right that just gives you the treasury yields in our sample. And here, the only thing I would like to highlight is that the sample, despite being relatively short, it actually captures quite a bit of action in the treasury market. We have the hiking cycle, we have the pause, we have the subsequent easing period that began around mid-2024. We also have an episode of a clear curve inversion as well, as you can see, most notably through the dark blue line going from the bottom to the top of the yield curve complex. This couple of graphs here give you the stablecoin flows that we use in the analysis. Aggregate on the left, the same, but just split by stablecoin on the right. Here, the booms and busts of the market are clearly visible. I will not go into detail, but one could also clearly identify specific events such as, FTX, Terra Luna, SBB. So those are clearly visible in terms of outflows or rotation out of Tether into Circle in the case of Terra Luna, and out of Circle into Tether in the case of SBB. Stablecoin flows are positive on average during our sample period, and they are also highly volatile. And of course, as you can see in the right-hand panel, the largest contributors to total stablecoin flows are USDT and USDC, which is not surprising given the very large market share that they have. This gives you an idea of the crypto shocks. In the left panel, we have the raw daily crypto shock series. It is very volatile with little or no autocorrelation whatsoever, which suggests that the shocks are plausibly exogenous. However, if we were to use them in the raw form, they may not properly reflect periods of persistent crypto booms and busts that are typically associated with large changes, in the demand for cryptocurrencies, and therefore in the demand for stablecoins, because as also Ronit made clear, they have established themselves as a sort of a settlement asset within crypto space, and they tend to correlate quite strongly with crypto activity. In the right-hand panel, what we do is we show the cumulative sum version of the crypto shocks. And this cumulative series does not exhibit any trending behavior, which is good, but at the same time does exhibit persistent booms and busts, which is also good because this is the kind of activity that we want to capture in terms of the instrument. We argue in the paper more extensively than I will do here that the shocks are a useful instrument for stablecoin flows because they satisfy the typical two conditions that an instrument needs to satisfy, namely relevance and exogeneity. With regards to relevance, the crypto shocks should be positively correlated with stablecoin flows. And this is what we show in this table in what is usually referred to as a first stage regression. In column 1, we do the first stage regression using only aggregate stablecoin flows, and then columns 2 and 3 show the split for USDC and USDT, respectively. Overall, cumulative crypto shocks are significantly and positively correlated with stablecoin flows. And then we also have robust F statistics that are quite large, which suggests that the risk of having a weak instrument is low. And then we also argue that the crypto shocks satisfy exogeneity conditions as well. Here we argue that to be sure, like the crypto market capitalization has grown quite a bit. It has stalled over the past 6 months to some extent, but roughly 3 trillion, give or take, is still dwarfed by traditional financial markets, which suggests that shocks in cryptocurrency markets are unlikely to have a systemic impact and systematic impact in the market for US treasuries, which currently stands at roughly 35 trillion. And then to further support this exogeneity condition, I think it's also worth noting that crypto shocks, the way we constructed, are the unforecastable component of cryptocurrency prices. So it is unlikely for these shocks to have any meaningful impact, causal impact on treasury bill pricing, except through the stablecoin demand channel that we try to document. And then also in the revised version of the paper, we also show that they are unrelated to potential confounders such as MMF flows, FCIs, and so on, and that the instruments themselves have predicting power for stablecoin market cap, for future stablecoin market cap growth, and also future Bitcoin returns. So let me now provide some first evidence of the link between stablecoin flows and treasury yields, and doing this by looking at 4 case studies. 2 of these case studies represent outflows. That is the collapse of Terra Luna and the collapse of FTX in May and November 2022, respectively. And 2 represent inflows, are more recent events. That is the US election in November 2024. And then the issuance of the Trump meme coin in early 2025. So what we do in this graph is to summarize the evidence from this case study. So let me try to walk you through the graphs. The first row gives you stablecoin flows and treasury yields. The second row gives you crypto shocks and the FCI, the Financial Condition Index of Goldman Sachs. Like if you focus now for the time being on the first row, this will show you the behavior of stablecoin flows and the 3-month treasury yields relative to the 6-month treasury yield around the events. We do it in a relative sense here to try to see whether there is any differential change in the 3 months relative to the vicinity, basically. The thick blue line that you see represents the average across all these 4 events. And then the solid blue lines give you the inflow events. And then the dashed light blue lines give you the outflow events. And we multiply the latter by -1 so that then we can show all together into a single graph that we can interpret in a straightforward way. Now, clearly, after these events, on average, stablecoin market capitalization goes up quite a bit to the tune of 10 billion. And the 3-month yield decreases, treasury bill yield decreases quite a bit relative to the 6-month yield. Whereas before the events, both were rather flat, right? And then in the lower row, what you see is that the cumulative crypto shocks kick in basically around the events, which makes sense. So they pick up. So these are seen as a positive crypto shock, or a positive boost to stablecoin demand, to crypto, and then therefore stablecoin demand. And financial conditions remain rather flattish. I mean, there is to be sure like a small dip in financial conditions, but this is also mechanical to some extent, given that rates themselves feed into the construction, are a subset of a very large superset of variables that feed into the construction of the financial condition indices. So then we go about presenting more formal evidence through local projections, where, as I mentioned before, we include controls, we include an instrument. The idea here is that we aim to trace the dynamic impact over time of stablecoin flows. We are going to do this all the time, scaled to the 2 standard deviations, which is roughly $3.5 billion of stablecoin inflows in our sample. And we want to assess the impact of this over time on 3-month treasury bill yields, again, after controlling for a bunch of things, and also using an instrument to get around potential endogeneity between stablecoin flows and treasury yields. I mentioned the controls and the instrument in some detail before, so let me skip over all of the symbols here to just go straight to the results to make sure that I'm able to present those with a bit more time. Now, this figure gives you the local projection impulse response function after including controls on the left, and then after incorporating on top of the controls also the shock series of the instrument that I was discussing as an instrumental variable for the stablecoin inflows on the right panel. So let me focus on the one on the right, which is our preferred specification, because we're basically throwing the entire kitchen sink in terms of trying to kill the effect. So this is the one that includes controls and the instrument. And here we estimate that a 3.5 aggregate stablecoin inflow will compress 3-month T-bill yields by about 2.5 to 3.5 basis points. The bands are wider, so it's less precisely identified, but it's more or less similar to the one only with control. So overall, the results point to substantially smaller effects once one takes into account endogeneity concerns. When we compare it to the naive version of the 25 basis points, the effects are considerably attenuated already after including quite a large set of controls, and they are also further, if only slightly attenuated, after including the instrumental variable. Now, as I mentioned earlier, we do a bunch of robustness checks that address potential concerns about the approach. Here I will focus on only 2, but we have like 4 or 5 more in the paper for those that are interested. And by the way, the paper has been already updated in the BIS website, so that's the latest. Well, done a few changes after that, but I think it's reflective of where the paper stands today. So the first thing that we do is we test whether the effects on yields are limited to the tenor that is associated with stablecoin issuers' preferred habitat. Again, historically, in most of our sample finishes before Genius, so this was before investment in a certain maturity range was mandated by legislation. But before that, the market had already converged towards using 3-month T-bills as a weapon of choice, basically, for parking reserves. So what we do is we test the effects of stablecoin flows on longer-term yields, and the way we go about this is by replacing effectively the 3-month yield as a dependent variable with all of the other various tenors. And the figure here gives you the case where we look at the regression with controls and with the instrument, so our preferred specification, And then we use 1 month, 6 months, and 1 year. So that's the upper row. And then 2-year, 5-year, and 10-year yields, following the same type of shock in terms of size. So 3.5 billion stablecoin inflow. There is a very mild effect on the 1 month, which is not so surprising because there is some investment in the 1 month bucket, although most of it is in the 3-month bucket. And there is basically no impact for the others. So these results are also consistent with the impact of stablecoin flows being concentrated among T-bills, which are the securities that they directly purchase. The estimates do point to some impact on the 10-year yield after about 15 days, 15-20 days. We suggest the possibility of some indirect spillover effects to selected maturities, and this is something that I think we probably would want to explore further going forward. A second thing to note is that the effects will differ as a function of liquidity regime. That's the thing that I foreshadow in my summary slide at the beginning, kind of a takeaway slide. In other words, the effects are state dependent. And the idea here is that when the system is in states of relatively low liquidity, then the effects are going to be strongest. And in contrast, when the system is in states of comparatively high liquidity, the effect is either much more muted or entirely or vanishes. Basically, it becomes statistically insignificant. As I mentioned earlier, the way we go about this is to take inspiration from a couple of recent papers in the Journal of Finance and do two things. We first look at regimes based on whether the overnight reverse repo facility is increasing or not. That's the upper row here. We take the 60-day change to capture more sort of protracted liquidity regimes rather than daily noise. And this is, again, what we show in the first row. We look at periods of no growth on the left, which includes also periods of decline, and then periods of growth on the right, which is usually associated with lower liquidity. And clearly, the effects are much stronger on the right and become even insignificant, or are insignificant on the left, even though the median point estimates do point again to a negative effect. But the bottom line here from the first row is that when you have low liquidity in the market, then the effects of stablecoin inflows can be substantially larger. The effect on 3-month T-bill rate can be substantially larger. The second thing that we do is we look at Google Trends data to have a continuous measure of intensity of concerns around the debt ceiling during an hour sample. And then after we have this daily time series, then we take periods where the indicator is below 5 on the left, and then above 5 on the right. So less concerns on the left, more concerns on the right, which captures, if I recall correctly, 4 big episodes during our sample of debt ceiling standoff. And again, when concerns about the debt ceiling are strongest, and hence when liquidity in the market is usually taken to be shallower, the effects of instrumented stablecoin inflows on treasury yields stablecoin flows, on treasury yields are strongest. Now, before wrapping up, let me move to a broad discussion of implications. And first and foremost, what does this mean, in the bigger scheme of things? So Ronit was talking about their forecast for the market. So in the paper, we take the Treasury Borrowing Advisory Committee forecast that they put out around the time in which we were publishing the first version of this paper, which now I understand, I think much better than actually comes from Ronit and his team. That's kind of the roughly 2 trillion market cap by in that case was when we look at it was 2028. Based on our estimates with controls with the instrument, we can do back of the envelope calculations. You can check the details in the paper about how we can come about this estimate, which is such a simple, it's just a simple indicative exercise, and it's not just like a simple extrapolation. It requires some assumption about how volatility of stablecoin flows grows with market size as well. But be that as it may, basically come up with an estimate that is, in the 9 to 12 basis points range. I think there are a couple of caveats here that one needs to discuss, and some of them were also foreshadowed by Ronit as well. So the first one, which was not foreshadowed, stems from the state-dependent results that I was talking about, right? So it seems that liquidity conditions in the market matter quite a bit when it comes to assessing the effect of stablecoins on treasury markets, on treasury yield, and the T-bill market. So one should not forget this, because the market has been subject to periods of severe illiquidity and some dysfunctionality, which has required interventions in the past. And second, that of course, and this is something that Ronit was foreshadowing when he mentioned the issue of net demand for treasuries, is that an exercise like the one I just presented you, in terms of having some ballpark estimate of the impact of a certain growth in the market on treasury bill yields, implicitly assumes that all of that additional demand for stablecoins will come from funds that are not currently directly or indirectly holding treasury bills, such that a growing stablecoin market effectively represents full net new demand for treasury bills. So what is nice for us in the context of this paper is I think that this is a very reasonable assumption from what we have seen so far over the past years, where the market grew kind of organically with a lot of retail money and some small pockets of institutional money, but institutional money that is not already invested in treasury bills, either directly or indirectly, so through a money market fund or an ETF that invests in treasury bills. Now, so this is a reasonable assumption, I think, for the stock take up to today. I'm not so sure, and I'm actually somewhat skeptical that this will be true going forward, especially if you remember Ronit's very first slide when he was talking about the expectation that institutional demand will grow and will be a driver over the next 5 years, which is a common theme you hear often, which I find very sensible. The likelihood that that type of money is already invested in treasuries, it's higher than what we have seen so far. So so one should take these estimates that we provide, these back of the envelope estimates, with a grain of salt. Be that as it may, I think our estimates suggest that a growing stablecoin market may eventually suppress short-term yields to an extent that meaningfully influences the transmission of Fed monetary policy to market-based yields. The paper also has some policy implications. First, on reserve transparency, I think these policies are set to interact with stablecoins' growing footprint in treasury markets. Here, the usual example, just think of how different is the visibility that we have on some issuers versus others. Then monetary policy is also set to interact with the role of stablecoins as treasury investors. Going back to what I just said a few minutes ago, in a scenario where stablecoins become very large, stablecoin-driven yield compression may weaken Fed control over short-term rates. And this is not just a theoretical kind of a thought exercise. We saw some things not that different with the Greenspan conundrum a couple of decades ago, when the Fed's monetary policy was not transmitting as expected to longer-term treasury yields. And at the time, this was largely attributed to outsized foreign investor demand for treasury securities, which was affecting treasury market prices. And then, of course, there are also financial stability implications that arise from stablecoins becoming large investors in treasury markets. For one, stablecoins remain a runnable instrument, and I have other work on this as well. And they could subject the market to fire sales potentially. And here I should also like to point out that our estimates are likely a lower bound in this regard because they are estimated mostly with the growing market. In such a setting, there is some leeway in timing your purchases. When you have fire sales, however, there is no such scope for discretionary timing because the liquidation of assets must be done on the spot to meet redemptions. So there is some potential asymmetry here in the effect on yields, and this can have important implications for financial stability. And finally, I think more generally, our paper contributes to document effectively the growing footprint of stablecoins in treasury markets and how this continues to blur the lines between crypto markets and traditional finance. So with that, let me stop there and thank you all for your attention.
Thank you so much, Iñaki. This was fantastic. And I think one of the USPs of this conference is actually, hearing from both experts from both the practitioner and commercial world and from the academic world. So combining those two perspectives, I think you just validated a lot of the earlier speakers' projections and also raised some really interesting topics. So hopefully this is very useful and informative for our audience here as institutional use cases develop, as we see the impact on our financial system and many other implications that I think people will take away. So thank you very much. Really appreciate it.